Today, I would like to explain about the financial position of Sunway Berhad. What I will explain including the liquidation, solvency, asset management, and profitability. The first one, we look at liquidation. Sunway Berhad liquidity position weakened in 2022 compared to 2021. Key financial ratio like the current ratio, quick ratio, and cash ratio all decline, showing the company has less ability to cover short-term debts. The drop in the net working capital and interval measure also suggests fewer liquid resource and lower financial flexibility. The company may need to improve its short-term financial strategy to regain stability. The second part is we look at solvency. In 2022, Sunway Berhad maintained a stable debt level with 48% of its assets still financed by debt. The company slightly increased its debt to equity ratio and equity multiplier, showing steady capital structure and financial leverage. Importantly, it reduced its long-term debt, improving long-term financial stability, but Sunway also become much better at covering interest costs, as shown by significant increase in both the times interest earned and cash coverage ratio. The company showed stronger solvency and improved financial stability in 2022. Then, the analyzing of financial position for asset management of Sunway Berhad. In 2022, Sunway Berhad improved its asset management efficiency compared to 2021. Inventory and receivable turnover rates increased, meaning the company sold goods and collect payment faster, improving cash flow. The company also used its working capital, fixed asset, and total asset more effectively to generate revenue. And then, this improvement suggests stronger operational efficiency and better use of resources. The lastly is profitability. In 2022, Sunway Berhad's profitability declined compared to 2021. The profit margin dropped significantly, meaning the company earned much less profit per ringgit of revenue. Both return on asset ROA and return on equity ROE also fell sharply, showing lower efficiency in using asset and less return for shareholders. This suggests rising costs or reduced revenue, and the company may need to review its strategies to improve their financial performance.
Assalamualaikum and good day everyone. In this part of our presentation, I will explain about the Sunway Berhad capital structure strategy. The company adopts a diversified capital structure that is centrally managed by the group treasury. Their key goal is to maintain a balanced debt to equity ratio, especially to remain stable during economic uncertainties. And in 2021, the gearing ratio stood at 45%, and this increased moderately to 52% in 2022. This indicating increased leverage but still within a healthy range. Sunway emphasized sustainability in its financing, showing confidence in its ability to manage debt without excessive risk. This capital strategy provides Sunway with both operational flexibility and risk control, aligning with long-term shareholder value creation. Next slide, we go to gearing ratio and long-term debt. Moving on to key ratio and debt structure, As of for year 2022, Sunway debt to equity ratio was 0.92, while the net gearing ratio stood at 0.52. This reflects a well-balanced use of both debt and equity to finance operations. Moreover, the equity multiplier was 1.92, showing that equity capital plays a significant role in its financial leverage. One of the most positive trends is the reduction in long-term debt ratio, which dropped significantly from 0.6% in 2021 to only 3.6% in 2022. This signal is a shift toward managing liabilities more conservatively, with total debt at 12.48 billion ringgit and equity at 13.57 billion ringgit. Sunway maintained a relatively conservative approach that support financial stability and credit worthiness. Now let's look at how Sunway managed debt and reward shareholder. The group debt composition includes 60% floating rate and 40% fixed rate borrowing, enabling them to manage interest rate risk effectively. The company actively monitor interest rate and foreign exchange exposure, reset hedges when needed, and disposes of non-core assets with low returns. This prudent approach has earned Sunway a strong Mark 1 EE credit rating from Malaysia Rating Corporation. In terms of dividend policy, Sunway practices a progressive approach. In full year 2022, they declared a total dividend of 5.50 cents per share compared to just 2.50 cents in full year 2021. This reflects growing profitability and commitment to shareholders. The dividend policy balances reinvestment and shareholder returns, contributing to long-term financial flexibility. Lastly, let's focus on Sunway Dividend Reinvestment Scheme, which is DRS, and their use of preferences share. From the second interim dividend in full year 2022, 2.00 cent was offered as new share under the DRS, while 1.50 cent was paid in cash. This allows shareholders to reinvest dividends and help the company conserve cash for expansion. Additionally, Sunway issued irredeemable convertible preferences share, which is ICPS, with a 5.25% semi-annual dividends based on a 1 ringgit issue price. This instrument provides flexibility for both the company and its investor. Overall, the reinvestment scheme and ICPS show how Sunway use hybrid instrument to reward investor, retain earning, and optimize capital structure. This ensures strong shareholder confidence while funding future growth effectively. Lastly, let's focus on Sunway Dividend Reinvestment Scheme, which is DRS, and their use of preferences share. From the second interim dividend in full year 2022, 2.00 cent was offered as new share under the DRS, while 1.50 cent was paid in cash. This allows shareholders to reinvest dividends and help the company conserve cash for expansion. Additionally, Sunway issued irredeemable convertible preferences share, which is ICPS, with a 5.25% semi-annual dividends based on a 1 ringgit issue price. This instrument provides flexibility for both the company and its investor. Overall, the reinvestment scheme and ICPS show how Sunway use hybrid instrument to reward investor, retain earning, and optimize capital structure. This ensures strong shareholder confidence while funding future growth effectively.
Next, I will talk about the factor influencing capital structure. First, the factor influencing capital structure is well-structured internal financial strategy. Sunway Berhad practices a centralized treasury function responsible for managing financial and funding strategies comprehensively. This ensures a balance between debt and equity in its capital structure. In the 2022 financial year, Sunway recorded a net gearing ratio of 0.52 times compared to 0.45 times in 2021, indicating a moderate increase but still under control. This strategy supports growth in development projects without compromising the company's financial position. Second, the factor influencing capital structure is cost of capital and interest rate risk. The cost of capital and exposure to interest rate fluctuations also influence Sunway Berhad's capital structure. To manage this risk, Sunway adopts a mixed strategy. 60% of its financing is through floating rate loan, while 40% is through fixed rate loans. This approach helps the company balance its exposure to interest rate changes. Furthermore, Sunway prioritizes risk management through continuous monitoring of interest rate and foreign exchange forex risk, including hedging measures when necessary. I will elaborate more about the impact of recent economic conditions and efficient capital management. The impact global economic conditions. Sunway Berhad is also impacted by challenging global economic conditions since the COVID-19 pandemic, including rising inflation, geopolitical pressures, and higher global interest rates. To address this issue, Sunways has taken strategic steps such as disposing of non-core assets that provide low returns and reassessing foreign exchange risks. These measures help maintain liquidity and focus on investment with higher potential return. For a strong credit rating, Sunway Berhad maintains a strong credit rating of MARC-1/AA from the Malaysian Rating Corporation. This rating is a result of systematic and disciplined capital management. With a good credit rating, Sunway gains access to financing at lower cost, even in challenging market environment. For the Dividend Reinvestment Scheme (DRS), Sunway Berhad also introduced a Dividend Reinvestment Scheme (DRS) that allows a portion of dividends to be paid in shares. This helps the company preserve capital to fund strategic projects without increasing its debt burden. This approach not only strengthens its capital structure but also demonstrates Sunway's commitment to long-term growth.
Next, let's we understand the key factors that influence a company dividend policy. Dividend policy are not decided arbitrarily. Company must strike a balance between rewarding shareholders and preserving enough cash for the future investment. One of the most important elements is the sustainability of earning and cash flow. If a company has consistent and predictable income, it's more likely to offer stable or generous dividends. But if the earnings are uncertain, the company will likely adopt conservative approach to avoid having to cut dividends in the future. Growth opportunity and capital needs are another major consideration. Company in the capital intensive industry like manufacturing or energy often retain profit to fund expansions. Meanwhile, business in cash-rich sector like consumer goods may distribute higher dividends. Next, we have the economic environment. Factors like inflation, interest rate, or market downturn can affect dividend decisions. In time of uncertainty, company may hold back on payout to conserve liquidity. Lastly, the capital structure play a role. Company with a high debt level might reduce dividend to maintain their PDHD. Conversely, company with a strong balance sheet and a low debt can afford to reward shareholders more completely. In short, dividend policy must reflect a company financial health, future plan, and market Sunway condition. Berhad dividend policy. Now, let's look at how this factor play out in the real world using Sunway Berhad as an example. In 2021, despite the economic challenges caused by the pandemic, Sunway paid out a dividend of 2.5 cents per share. This conservative payout showed their commitment to shareholders even during the tough time, while ensuring they had enough cash to keep the business stable. By 2022, as the company performance improved, they increased the dividend to 5.50 cents per share. This increase reflects Sunway's stronger profit and confidence in its future cash flow. Importantly, the company maintained a healthy net gearing ratio of only 0.52 times, which show a strong capital discipline and financial stability. To further support growth, Sunway implement a dividend reinvestment scheme (DRX). This allows shareholders to reinvest their dividends into company share. It is a smart strategy that perceives a cash or investment while still rewarding loyal investors. In conclusion, Sunway dividend strategy illustrates how a company can adapt based on both internal financial and external conditions. Their approach ensures the long-term growth, financial stability, and continued shareholder confidence.
Hello and Assalamualaikum. My name is Muhammad Fikri bin Nasri and my registration number is D2023 1107 24 and 6. Now I will be presenting on how Sunway Berhad effectively balances its needs for growth and investment with its responsibility to reward the shareholders. This is achieved through a strategic combination of capital management, diversified business operation, and a shareholder-friendly policy. First of all, Sunway's financial discipline is demonstrated by maintaining a dividend policy that aligns with its performance. One key initiative is the Dividend Reinvestment Scheme, DRS, which allows shareholders to reinvest their dividends into a new share. This is not only increase shareholders' equity, but also helps the company preserve the cash for reinvestment into other high-growth areas. It is a win-win situation where shareholders for long-term value and the company strengthens their financial positions. Secondly, Sunway has expanded across multiple sectors, including property development, construction, healthcare, and education. This diversification has been crucial in supporting the company's financial resilience. In year 2024, Sunway achieved a record high revenue of 7.88 billion ringgit Malaysia and a 56% year-on-year increase in a net income, reaching 1.15 billion ringgit Malaysia, are not from a single segment, but from a balanced contribution across the board. For instance, Sunway Construction and Property Division alone secured an order book worth 5.2 billion ringgit Malaysia in 2024. The returns from this segment have helped fuel growth in newer areas such as healthcare and education, reinforcing the company's long-term vision. While from a market perspective, this balanced approach has been well received. Sunway share price rose 65% over the past year, boosting its market capitalization to 28.82 billion ringgit Malaysia. Despite aggressive investment, Sunway still delivered a total fixed dividend of 6 cents per share, a clear sign of its commitment to the shareholders. So, in conclusion, Sunway Berhad has proven that with strategic capital management, business diversification, and consistent shareholder returns, it is possible to achieve sustainable growth while fulfilling dividend obligation. It is a model that many other companies can learn from. So I think that's all from me. Thank you for listening. Thank you.